Hey, what's going on, Cashflow hackers? It's Chris, Life 180, and I am here in the My City Lender studio. Pretty cool spot. I should come use this place more often, guys. But so I got Jay and Brian from My City Lender here with me, and we are talking about, I guess we're going to talk about kind of like the current state of the economy, and the market, and
that's what everybody wants to talk about right now.
It is, and there's all sorts of crazy information out there, all sorts of varying opinions about what's happening. You guys are two guys that I respect immensely in the space.
Appreciate that, Chris.
Thank you, Chris.
Yes. And thanks for having us on.
Yeah, man, it's awesome. And this is the, full transparency to everybody. Jay's son and my son play on the same soccer team.
And have
for years. And so we built a really cool relationship over the years. And
the wives are friends.
The wives are friends. And so it's really cool. But you guys have this really cool, mortgage is a brokerage, right?
Yes.
Yep. Mm-hmm. Mortgage brokerage here in Gilbert, Arizona. And you've got how many lenders that are employees or
13 total.
13 total. So you guys are pretty tapped into the market.
Yes.
About what's going on.
I would think so. I would like to think so.
Right.
Yeah, I would like to think that too.
And your livelihood in your business really depends on you having your finger on the pulse of what's going on.
Agreed.
Right?
Yes.
Yeah. So that's why, rather than me just like kind of give my opinion, I love to be able to ask questions. And obviously I have my strong opinions, but I think it's different when you guys are, when you're talking to people every single day and you're, it's you guys are on the front lines talking to clients about their fears, their concerns, their, the reasoning behind not being able to, buy, or maybe they kind of get pre-approved at one rate and then the rates go up and then they're not approved and they have challenges, or I don't even know if that's happening right now. I know it was happening for some people at one point in time. What are you seeing? I don't know who to start with here. Who wants to go first?
Well, we're not really seeing. I'll comment on the rates going up, and we're not really seeing that cause people to become not qualified. I don't think we're seeing that very much. But it is causing people to be really nervous about whether or not it's the right time to buy a home. I mean, that's sort of the standard question. We should preface this probably by saying we don't have our crystal ball today. So I always tell my customers, where are rates going to go? Well, let me
the magic 8 ball. Let me go.
Do you
remember that? That's great.
Those are awesome.
If I knew where rates were going to go, I would probably be not talking to you right now and be a very wealthy futures trader.
For sure.
But yeah, no, I mean, being in the mortgage business, we're obviously keeping a real close eye on the local housing market in particular.
Of course.
And there's so many dynamics here in the greater Phoenix area that are all kind of feeding the record low demand that we're seeing right now for mortgage applications. I think lowest since 1995, right, Jay?
Yep.
So housing affordability, it's come out that it's kind of like at an all-time low.
Yeah.
Right? Which is not a small statement. And so, So what are you, Jay, I'll ask you this first and then you can tap on. It's like, what are you seeing as the main causes for housing affordability being so horrible?
Well, you've got prices right now that are they're higher than really what the market can sustain. We're losing a whole segment of buyers, like our first-time home buyers, the people that were on the fence for so long and they were thinking about it, and it could have been 2, 3, 4 years that they've been thinking about it.
For sure.
With what we've seen this year, it's just become to a point where they're off the fence at this point. They're really not interested in moving forward until things change. Yeah. As we see things maybe hopefully improve as we go throughout the course of next year and maybe into 2025. Hopefully we're going to see our first-time home buyers back. But getting back to what's causing this, it's just we have record high inflation, record high home prices still, and record high mortgage rates for the first time in 20 years.
Generationally high, for sure.
Yep.
Yeah.
Yeah, and as crazy as it sounds, with record low demand for mortgages, the supply is not catching up. It's a supply-demand thing, right?
Yep.
So values are remaining fairly steady. I mean, we're seeing some retraction in certain spots. I mean, real estate's extremely local. But getting back to the first-time home buyers, you use the word... I think you use the word desire. They don't desire right now. They all want to buy a house.
Yeah.
The desire for first-time home buyers to get into home ownership, I think, is up there, but they can't.
And there's a fear. There's a whole market fear.
Yeah.
Like if I buy this, how can I know that I can still afford this?
Yeah. Well, I think it's like when I look at going back to when we bought our first house when I was 24, it was a function of buying a house had to make sense, right? Because like buying a house it's got to be more affordable to buy than it is to rent. And if it's not, there's got to be a real compelling story as to why I should buy.
Well, over time, it's absolutely true that I believe. If you bought a house today for $500,000, if it never appreciates, 30 years from now, you have $500,000 and you've presumably paid it off by then. You have $500,000 in an asset sitting there that you wouldn't have if you'd been renting this whole time.
Okay.
Right. But it's probably going to maybe average 3-4% a year. Over the long term, maybe more.
Sure. Yeah. Totally.
So over time, I'm a firm believer that owning real estate, owning your home is better for your long-term wealth building than renting. Some would argue, well, if you're renting a house, you're still making a payment, that you're not really sitting there with extra capital. You could go invest in other directions or save in other directions.
No, I think the fact that, real estate's a hard asset that is going to go up with inflation naturally. The land is the one thing that's not being created these days, right? At the end of the day, the population grows, economies expand, people, our demographics expand, the real estate's going to go up. It's just the way it is. I think it'll go up and down and go with the cycles of the markets for sure. But, I'm 100% in agreement with you as far as all right, real estate's a really, great long-term play, and it needs to make sense on a short-term basis, emotionally for people. Because at the end of the day, if you get a 30-year mortgage, 98% of that mortgage is going towards interest for the first couple of years, right? It's a long-term play. And so but we've talked on our last video, people don't think long term, right?
That's especially hard for younger families, right? They don't really see the longer term. They're really more focused on can I qualify? And a lot of them cannot qualify right now. But then even if they can qualify, the typical home here in Maricopa County, you're looking at about a $3,500 a month mortgage payment, versus about $2,500 a month for a rental payment for the same property.
That's crazy.
So the younger generation who have a tougher time looking at the long term, and hopefully our generation starts educating. We have to start educating our children about it. And I'm in my kids' ears about it all the time, but most kids aren't coming in equipped with a long-term mindset. And so they look at the rental thing and they go, well, why would I even bother buying a house right now at 8% and $3,500 a month when I could rent the same thing for $25,000?
Well, it's interesting. I always say life doesn't exist on a spreadsheet, right? And it's
I love spreadsheets.
It's easy to spreadsheet these. I'm a nerd too. And I love doing illustrations and performance, spreadsheets and Excel things out and figure it all. But to that accord, we can make the best spreadsheets in the world where if everything went perfect, okay, that's great. But that's not how it works, right? Things don't just operate perfectly. Life happens, emotions happen. We have to make decisions for emotional reasons that don't necessarily make mathematical sense. And so then our spreadsheet gets turned on its head with one little change in life and decisions. And one of the things I think that's interesting about this, because, 6-7 years ago, I started my channel in 2016. And I remember I used to do a lot of videos talking about, even back then, I was thinking that the market had to go bad again. I was, because we got through 2008, quantitative easing 1, 2, 3, money printing, all the things, right? And so I was thinking by 2016, all right, how much longer can we keep this going? Well, apparently 7 or 8 more years, but but
those were leased, right? They really were.
Yeah, they were, but here's the thing is I could show a spreadsheet showing, all right, you're not buying your house based on the fact that it's $500,000. You're buying the house based on what you can afford to pay for it monthly, right? Now the value, you got to be able to come up with the down payment based on the value of the house, according to the loan terms. But if you're, doing a $500,000 mortgage at 4%, you're probably in the $3,000 range after taxes and all that stuff. But now at 8%,
$1,000 more a month.
$1,000 more a month. Yep. And so there was that old rule that we used to follow that would say for every 1% of interest rate that it's going up, the housing value is going to go down by 10% because that's what you can afford. Yet we have seen like the opposite happen. Rates are going up, housing prices kept going up. Now they've kind of like fluctuated and kind of like leveled off and topped off at this point in time. Why is it that old school, I mean, that was kind of the rule of thumb in every market, every economy that we've ever seen in the real estate market. As rates go down, values go up. As rates go up, values come down. We've broken the system. Why?
We haven't seen this before.
Well, 90% of financed homeowners out there have a rate less than 5% right now, like less than 4.5%.
90%.
It's a big number of those who have loans on their houses, because everybody took advantage of the crazy low rates during the pandemic, right?
Yeah,
myself included.
Yeah. So the last time this did this as dramatically as it happened was like 1981.
Yeah.
As far as like to see interest rates, almost or more than double where they were. It doesn't matter where they were, but they've more than doubled where they were. You've got this intense shock effect that's happening with this like rubber band effect on value, home values, mortgage rates. Nobody knows exactly quite what to do with it. So
you just spoke to the people at the Cromford report.
Yes.
Which, if anybody's not familiar with that,
we had Tina Tambor. Yep.
So, like
on the Jay and Brian show, she was a guest.
There you go. So if anybody wants to watch that show, I'll put the link in the description below. I'm sure it's full of awesome. Full transparent. I don't even think it's public yet.
It's not yet.
Okay, so I haven't seen it. I just know you guys talked to her. So give me like your top two, or like one to two, three takeaways each of you, like from that show.
So Tina is kind of like the oracle of the real estate industry as far as analytics go for the Phoenix metro area.
Love it.
But the Cromford report is a national publication that's available online, and Tina actually writes a lot for the report itself.
Cool.
And what she was telling us about kind of the state of things, she's seeing more on what's happening is generational. And this generation hasn't quite seen or experienced anything like what our parents' generation experienced. Like we were even just covering like
when you say this generation, you mean
generation,
like
our
us?
Generation. So Gen X, Gen Y,
people hitting their peak spending years now.
Yes, like our parents, millennials are the future. Now. Like this is our. We're counting on as a culture, as society, we're counting on the millennials to buy homes. If the millennials don't buy the homes, then where are we? And so this was part of the conversation that we had on our channel. So tune in as we get that episode.
Yeah, and I mean the fact is that the millennials, which is the generation younger than us, and then it's the Gen Yers, I think, that are
I don't know. I'm like on the cusp. I'm 1980, so it's like
you're 1980.
Yeah, okay. So that's technically.
Are you an old millennial? Is that what?
I'm the oldest of old millennials, technically speaking.
How old are you? Can I ask you that?
I'm 43.
43. Yeah.
Don't judge me.
Don't judge me. Yeah. So there's just a huge, as far as the society is, we're betting, not just the real estate industry in and of itself, but society is betting on the millennials buying and owning homes. And so if we get to this point where they have to show up for us, please show up. Please show up.
Don't let us down.
But the reason they're not showing up is because of affordability, and that's so a lot of our conversation with Tina. One of my takeaway really revolved around the affordability question. Okay. And there's only two ways to fix it. There's values have so affordability is there's a couple different aspects of that. There's the interest rate. So you're going like holy cow, my payment's $3,500. It could have been $2,500. A couple of years ago. So I've missed it. I've completely missed the opportunity. Millennials think that they have missed their opportunity, which I think long-term is not accurate at all. But many of them think that they've missed it from that standpoint. But even those that can afford, and they're looking at we talked about that too, their income, and they have the ability to qualify for that mortgage, they don't have the funds to put down. And even the ones either they don't have the funds to put down, or they have mom and dad who can put funds down, but then those ones aren't earning enough income to afford the house that they want.
Yeah.
So it's like,
So she was even saying that we're going to see combining forces, different,
Yep.
generational family purchases,
Yeah.
groups of people, tenants in common type purchases
Okay.
are going to be coming. But one of the other things that she really, that we kind of solidified in the conversation too, is that the millennial generation is out earning like Gen X. They're out earning us as a generation. So it's like Brian just said, they a lot of the millennials, they can afford to buy.
Sure.
And so it's, how do we get them connected to why they should buy?
So it's really a shift in culture. I mean, when it comes down to it, it's a difference in priorities. It's a difference in like how people want to live their life. And I mean, at the end of the day, if we start seeing these like families going together, and listen, we've talked about that. My wife and I have talked about it, not because we have to, but because it's like, we enjoy being around family as well, right? Like, and we enjoy the freedom that comes with having the grandparents live in a close vicinity, you know what I mean? To watch our kids if we need to travel for work or do our real estate investing or do anything we're doing. There's a wild amount of convenience that comes along with that, And so like, and if you have families doubling up, even if we had 10% of families doubling up, that really shifts the need for the amount of real estate that, so the supply demand.
Yeah, and you saw that it was probably 10 years ago now when Lennar rolled out the Gen X or next gen homes.
Yeah.
With the home in the home.
Yeah.
And,
I read an article the other day, and I'm curious to hear your feedback on this, and it was about Phoenix specifically, about some of these new home builders and the programs that they have, and the fact that, it's really hard for the market for people in the resale market, because right now, if I want to sell my home for $1 million in Ocotillo, it's 8%, probably 7.5% to 8% ish in that range at the time we're filming this, that somebody's going to be paying for that. And so now I'm up against it versus, sure, like there's not a lot of homes, and if we find the right buyer and we got a good lot, and we got those things going for us. But with 8% mortgage rates, now there's other new home builders that are like incentivizing and giving incentives and doing buy downs. I heard yesterday, and tell me, like, is this like, my head about exploded when I read this. They're doing, new home builders are doing buy downs and incentives to get people's rates down to 5.5%.
Absolutely. That's absolutely what they're doing.
How can the rest of the market compete with that?
The resale market really can't. If I was a first-time home buyer or a millennial, I would be doing everything I can to, and I don't already own a home.
Yeah.
I would be going to the builders, because that is
totally
absolute bona fide dollars in your pocket that they're paying for.
All the things we're talking about right now.
So it equates to like $30,000. That's what it's about $30,000
in payment savings over the first 3 years. Yeah. It's crazy.
It's hard to fathom.
I'm like twitching over here. I'm like, well, there's a glitch in the matrix, guys. Like I don't.
So
I read that and I was like, there's no way this could be true. The new builders
are selling a lot of homes right now. When you look, I don't know the exact percentage, and I think we talked about this with Tina maybe. The home builders are making up the vast majority of all home sales right now.
So if that's the case, now that gives me PTSD. Like, not to I shouldn't use that term over the top, but like, it is what it is. Like, because I go back to 2004, 5, 6, 7, 8, and there was this boom, and the home builders like took over the market, especially in this area, right? We bought our home from a home builder. We bought our home with everybody around us was doing, variable rates, 5-year ARMs, all this stuff. And my wife and I took a 30-year fix because I was like, no, we're going the conservative route. Right. And we bought out in Maricopa. Not, in Pinal County.
What year was this?
2004.
We did the
November of 04. We bought out there, and then our house doubled in value in like a 3-year period. But then in 2007, we went to go sell it, and it dropped 80%. 80% in 6 months. Like, it was the most.
It was scary.
It was the worst, right? So like, I look at, and the thing is if you went out to Maricopa for 8 years after that, 9 years, even up, like right now, developments that crashed are just now starting to pick back up and get back on their feet and start to build again. And so I'm looking at this, when I read this article, I was like, holy crap, that's not good. You know, like,
is it happening again?
Is it happening again? Because you don't get anything for nothing, you know, and like, and especially off the heels of the fact that, you know, these builders, if they're offering this now, we're coming through this high rate of inflation where the lumber was expensive, materials were expensive. Mm-hmm. If they're offering these incentives, they're not making a lot of money. These builders are just, to me, they're
doing it to move inventory.
They're doing it to move inventory, because if they don't, they know they're going to go bankrupt.
Yeah. Like they'd be super quiet, just like the resale market is right now.
Yep.
Yeah.
And
sure.
So we have the buy down programs available as well.
Okay. Talk to me about that.
So for resale real estate, we still, we have a 2-1 buy down, which is basically like the first year. Let's just say, for the sake of the example, rates are 8%, just for the sake of the example. Mm-hmm. Well, the first year in a 2-1 buy down, the interest rate would actually start at 6%. Mm-hmm. And then the second year it goes to 7%.
Okay.
And then the third and final year and moving on forward would be at 8%.
Okay.
And so what has to happen?
And the seller pays for that.
The seller actually has to agree to contribute to a subsidy to buy down the interest rate on a temporary basis for the buyer. And then if the rates, if the rates go down, they could always refinance out of that loan. Mm-hmm. Okay. It's still a 30-year fixed loan, or they keep the loan and rates go to 10, then they're still locked in at 8%.
Yep.
So,
and homes are taking longer to sell right now as well. Yeah. And so we are seeing more appetite for seller concessions, for sellers to need to do that to incentivize the sales. So there is the funding mechanism to make that program a really good opportunity for buyers.
And now there's also a 3-2-1 buy down available.
And that's kind of like what the builders are doing. That's where you go for 5. About. Yeah.
So that's over a 3-year period.
Yep. So in those cases, though, you're looking at a $18,000 to $22,000 rate buy down from the seller in a 3-2-1 buy down in our market. Yep. That's what it would take to get there. Mm-hmm. So the 2-1, as far as the resale market here, the 2-1 is still kind of the primary product.
And what does that cost somebody? Like, if I were selling my house and I wanted to offer that incentive,
you're literally making up the difference between the 5% payment and the 8% payment.
So the seller's really financing it.
Correct. Yeah.
Out of the profit of the
proceeds
of the house.
Yep.
But the alternative is just sit
maybe
on the
$12,000, $9,000 to $12,000 somewhere in there.
That's a lot. So you're saying these builders,
get the house sold.
So you're saying these builders they're paying $30,000 out of they're literally stroking a check for $30,000 effectively to buy this down just to move inventory. And so a lot of people see that as a positive thing. I don't want to be Debbie Downer here, but I look at that as a super glaring red flag for the market.
Well, it's not a qualifying. So it's also important to clarify that when you do the buy down program, you're not qualifying at 5%. You still have to qualify at the 8% payment.
I understand.
But then you're talking about 3 years from now when it hits you in the face that you're paying.
I'm not even talking about that. I'm talking about just the human behavior and the incentive of the fact that these builders are so freaked out about needing to move inventory like this. That tells me
putting that much money,
they see what's happening.
And by the way, that's potentially on top of builder incentives.
Yes.
Like, here's a few
closing costs.
Right, closing costs and extra upgrades and stuff of that nature. Yeah. Wow. Yeah. That's crazy. Do you guys do do they do their own financing, or do you guys work with new builders at all?
We do. We actually have worked with several builders here in our area. But again, it just depends on, can you get the builder to honor the incentive so that we can still work with the buyer?
Got it.
And sometimes it is.
We've seen some of that where it's taking less time to build a house right now, but 6 months from now, they come to us today, qualify them, and the builder's got this incentive on the table, and then it takes 5-6 months or longer. The deal can change somewhat on them. I think we've seen it a couple of times.
Mm-hmm. So where do you guys see things going right now? I mean, it's tough. You guys are in a tough spot. I'm not. Yes. I'm in a business right now. Things are booming, right? Like because people are looking for financial security. And, I've been very consistent in my messaging over the past 8 years on the YouTube channel. And so everything I've been saying is going to happen is now finally happening. So I feel really good about myself.
You're all justified.
I'm finally, guys, I told you. But at the same time, I don't get satisfaction in being right about this stuff. I have been talking about it for all this time to try to help people, right? And help. And unfortunately, people haven't done what they need to do. And so now that they have to, and now that it's real and they're thinking, oh my, this is going to get ugly and whatever, they're now looking to make different financial decisions, and so they're looking for the security that our strategies kind of like position people for. But you guys are in a different animal. I mean, your business right now, I mean, you guys do a great job, you know, but it's a tough market.
It's a tough business.
It's a tough market.
Our business is down.
So what are mortgage people doing right now, like, to survive? Like, how are you, like, what do you do?
Side hustle.
Well, I can speak to my city lender.
Sure.
First of all, we launched as an independent broker about a year and a half ago, having been a branch of a larger retail mortgage company for many years. By doing that, it's opened up other avenues for us to explore. So, you know,
including this conversation that we're having today.
That's true. That is true.
Yeah. Good point. The podcast as it is now, the Jay and Brian show it struggled to exist the way we wanted it to. I'll just put it that way.
It's given us a creative freedom.
It's awesome.
But as a broker, we're obviously home loans is what we're really good at. It's what we know. It's what we drive at every single day. But we have the ability now to look at other avenues like commercial brokering or hard money lending. I mean, there's different ways that we can approach a market like this and ultimately build out, I think, other business lines. It's a long-term view, but maybe helps us in the short term.
Our licensing allows us to do that. So we have like multiple.
You can get in the hard money lending space?
Private money, sure. Yep. As long as we don't service the loan. So we just have to outsource the servicing of the loan.
Correct.
Which would have to go through a title and escrow company. Yep. So, but our license covers that. It covers commercial.
That's cool.
Look at all this discovery we have.
And we've
today.
been building relationships with regional banks, credit unions, other long established commercial brokers that we can, when people come to us, we get a lot of calls like, can you do this? Can you do that? And we're building these bridges to other ways of helping people get financing that they need.
That's awesome.
Yeah.
That gives you guys flexibility in a way it doesn't give other people, or other people in the business that maybe don't have the ability to have those other lines of business in this market that you can do. Then I guess it's just a function of marketing for you guys and like going after that business, right? And like staying focused on it.
And marketing other types of businesses too, like, kind of like what we had talked about. But it's an ever evolving, ever changing thing. In fact, before you came in today, Chris, Brian and I were just kind of talking about, like our industry has changed
100%.
And so it's up to us to manage it responsibly, to manage our business responsibly, manage the moment responsibly. And you have to adapt to the change.
Well, the crazy part is like we see these cycles, right? We see the real estate and mortgage cycles. I mean, when 2000,
but I can honestly, I can attest to this. I have never experienced this. This is my 20th year in the mortgage industry. And again, like getting into like a generational, we're seeing something that we haven't seen in a generation of time.
How is this different for you than 2008 and 9?
The market was still moving in 2008 and 9.
What?
Yes. The real estate market was still moving,
even though like all the foreclosures were happening and all that.
Yeah, in fact, it was helping to stimulate the movement. Whereas right now, I feel like the resale market has stagnated. Like we're in this holding pattern that I can say I have not experienced ever.
Even foreclosures right now are still near all-time lows.
There's no foreclosures.
There's a reason for that. It's because on the heels of 07, 08, which was a massive mortgage credit bubble.
That was caused by the industry. There is no mortgage credit bubble today. Everybody is. I mean, there probably are some dark pockets of the world nowadays where you can find some crazy lending, but it's just not a thing. You have to credit qualify for every loan you have. You want to buy an investment property, great. You need to prove you have enough income to support your primary home and your motor home and the investment property. DSCR, unless it's that.
DSCR, but even then, you got to put 30% down.
Do you guys do investment property loans?
We do.
You do? Yeah. All right. Well, that's good to know.
Yeah. And so you don't have the credit bubble going on right now, and you have at the same time you have people with all this equity. So yes, we could see foreclosures uptick if we go into a recession and unemployment ticks up for sure. But it's not going to be this big massive problem because people aren't underwater in their houses right now.
No, they'll just sell the house.
Yep.
You know,
Yeah.
if the
Go-
average
if they-
homeowner
go
has
rent.
200 grand in equity in their home,
The average-
they're just going to sell it.
The average today
Yeah.
is 200 grand across the country.
Well, that's what we were looking at. It. We bought our house in January of 2020, so it was like the perfect timing,
Yep.
right? And
Yep.
then, the pandemic happened, everything got shut down. We were scared to death, and we were like, "Oh, we just bought this place," and it's like, spent a lot of money on it or whatever, and like we got our house for like 600 grand, right? Like we're like, it is what it is. Like, and it was the perfect location. I mean, like the house needed a little work, but the location is why we bought it. And then. Yep. So then we're in it and we're like, oh my gosh, we got to put this money into our house now. And now it's going to go down in value. And then the opposite happened. It went to like, it almost doubled in price in like 2 years.
We bought in the fall of 2017.
It's insane. Oh, so you're scored. Like,
And I was like, we're buying high. It feels like we're buying high, honey, but it's our primary home. We're good.
But it's hard now because now, like I honestly, it's a, I don't know, it's a hard thing to complain about. Right. But at the same time, I feel trapped. Right, like in a normal market,
Absolutely.
I want to get out. In
Correct.
a normal market with the way my life is going right now, I want to sell my house. I would, in a normal market environment, I would sell my house.
Because you feel like you can get a lot out of it and do something.
I'd be able to
go on to your next thing.
recapture that capital.
Yep.
Because your home, in my belief, is not a great place to store your net worth. Right.
Yep.
And so that's just a principle.
Maybe safe.
Is it?
Maybe if you can get to it.
Yeah, maybe. But when can you get to it?
Yeah.
In times of
credit
need
or
yeah,
whatever
but then if the market goes bad, they freeze lines of credit up, they dry up,
Right.
The equity in your house is susceptible to lawsuits and stuff. There's all sorts of things. There's all sorts of reasons I just don't believe having, your equity in your home and just finance it for as long as you can, as much as you can, and pull money out, control that capital, all that stuff. That's just Dave Ramsey hates me, but like that's a philosophy, right?
Yeah.
But like that philosophy right now, circumstantially, is turned on its head. It doesn't make sense, right? Like we looked at like doing a home equity line of credit, and it's like 9.5%, and I'm like, what? Like no, like,
That's all?
That was a couple months ago. Like
Okay.
it's probably higher than that now. You know what I mean?
Yeah.
And which is mind numbing, right? Like it's crazy. But we're looking at this, and I'm like, and it's frustrating because I'm like, I've got $600,000 of capital.
Yep.
Hostage.
Yep.
Hostage.
Yep.
And it's like this.
You can't do anything with it. You can't deploy it. Yeah.
Mm-hmm.
It's the worst. Right. I guess there are worse things, but like, it's very frustrating. I feel trapped. Like, cause we're making this big shift, and it's like, I would sell, and I would take that 600 grand and I would deploy it and I would do things with it. But now it's just stuck and I can't touch it. Mm-hmm. And I refuse to pay 10, 11% to access it for a line of credit. That's just stupid. Like the idea of like, if lines of credit was 3%, 4% like they were 3 years ago, mm-hmm. all in, let's go. Right. But right now that just doesn't make any sense. And so like, the whole market right now just doesn't seem to make sense. And like
Have you seen these equity financing firms?
Tell me about it. Tell me about it.
Yeah, there's equity finance, so they'll partner with you. I can't go into details. I can't promote this.
Yeah,
okay?
you're not promoting it. You're not promoting it.
I haven't really researched it.
Right. So anybody watching this, he's not saying this is what to do. He's just
saying this.
Right.
Okay.
Yeah, like we're being real clear about
but
that.
But they're like financiers where they'll partner with you on the equity that you have in your home. Okay. And then you will partner with them on the future equity of your home.
Oh, so they're investing in the home and allowing you to live in it.
So let's say they'll come in, Chris, hey, we're going to partner with you on your home. We're going to give you
$300 grand.
How much are you looking for right now?
$400,000.
We're going to give you $200,000.
Okay.
And then you're going to basically sign us on as an owner on the deed of your property.
They're going to go on the deed.
And we're going to partner on future equity. And that's how
now
these deals work.
They get a split of the future equity growth of the house.
This is like a contract for deed.
Okay.
This sounds a lot like a reverse mortgage.
Yeah. It's kind of like that.
For non-retirees.
Yes, That's pretty much what it is.
People get creative. That's for sure.
Only there's no partner in the reverse mortgage.
I want to, I want to study the numbers on that. Does the owner, is there an equity stripping, risk of that for the owner?
Yeah, there's got to be.
Yeah, definitely.
Yeah.
I mean, they're not going to do that for nothing.
No, of course.
Like there's, that just,
so that's out there.
Interesting.
Equity investment. Yeah.
I would never do. I don't know that I would ever do that. Like, I'm a control freak, right?
Yeah.
So I'm not gonna like. I don't want to bring other people. Like a bank.
It's out there.
It's good. It's good. Yeah, I know.
It's a product that's out there.
It's tough.
It's not something I'm promoting.
But no, I get you.
It's out there.
So we're in this market though. Like, so when I look at things like that, when people start getting really creative, and when people start, like, to me, a lot of people look at this stuff as positive, and maybe I'm boring, maybe I'm lame, like, I don't know, but like, I like control and predictability, right? And then when I want to take risks, I want to do it in things that I have control of, you know, and things that I have influence in the success of, you know. That's why I don't like the stock market. Yeah. You know, do you know who Garrett Gunderson is? Mm-hmm. So I was just up at his cabin. We were doing a full day of video, and, you know, we're doing some stuff together. And one of the things that came up in this conversation is, like, he believes Wall Street is a value extraction machine, not a value creation machine. Which, think about this, like it's the bankers and all these, like, money managers and fund people and the goal is to really just extract value and, you know, collect as many dollars give the least amount of return possible to collect the most in fees possible. And that's what it's about. And from a long-term perspective, you may have some potential growth, but they're going to give you the smallest growth possible that's going to keep you incentivized to keep going, right? Like, and so, you know, my mindset is from a principal perspective, only investing in win-win scenarios, you know, and only going from a place of, like, just a win-win, meaning if I'm going to put my money in something, even I like real estate because I can invest in real estate and I could rent that house out to somebody, and now somebody's got a place to live, and you know, that's a win-win. Like, you're providing, it's actually creating value for somebody.
That's true.
You know what I mean? Whereas, like, if I put money into a stock, like, maybe it's not, like, but typically there's a winner and a loser in all those things. It's, you know, and it's, I don't know, that would probably be a whole nother episode to talk about, but it's really fascinating when you break it down. If
you're a publicly traded company, you want people to invest in your company because it gives you more ability to expand and employ more people and provide more opportunity for others.
Sure.
And your customers, depending on what it is you provide.
For sure. And if you invest in companies that provide a dividend and that you believe in, and, you know, like, a lot of people love investing in Apple, love investing in Tesla, love investing in those kinds of companies. And that's cool because that's that can be a win-win scenario if the company, the mission of the company is in alignment with your values, right? Like, that's cool. You know, but there's way more scenarios that are not that way, you know, and there's a difference between buying a stock directly with a company and buying shares of companies and then buying mutual funds that are segments of all these companies, right? And I think that's the difference. That's what I'm talking about. It's like, if you look at the Wall Street is not Elon Musk, right? Launching Tesla, like, I think that's how most people look at it. Like, if I were to invest in Tesla, I'm not investing. I'm investing in Elon Musk.
Yeah,
right?
Exactly.
That's like all the Shark Tank guys and gals, like, that are on there. They always say, like, they hardly ever invest in the actual company. They always invest in the entrepreneur and the person. Right. So, like, people invest in Steve Jobs. People invested in Bill Gates. People invest, like, their ability to take these companies where they went. That's just the reality. And so, but then when you get to Wall Street and the function of Wall Street, that's not the companies. They're the distribution vehicle for us to access, and there's always a cost for that access, and that cost is not.
And their incentive is to extract as much value out of it as they
100%.
can.
And especially through the creation of these mutual funds, and, you know, they're all sold as these, you know,
great investment vehicles,
right? And what they do is, like, when you add it up and you look at the fees and the internal costs and the structure and the volatility, like. It hardly any mutual funds. I saw a statistic, like 96% of mutual funds underperform the S&P 500. Like, it's crazy. When you think about it like that. Yeah. But you know, people keep doing it. So I don't know. But so where we're going right now, like, if you, what are you telling your customers? Like, right now, like, that's got to be a fun conversation.
So up until now, I've been largely wrong because I you know, heading into the, you know, watching rates going up and like this, started studying, you know, the inflation index and keeping a close eye on that. And historically, mortgage rates, long-term rates have tracked the inflation trajectory, right?
Got
So
it.
the direction of inflation. So as the Fed gets inflation under control, my expectation's been that we'll see it's flattening, right? Hopefully. There are those who are thinking that rates could go 10, 11% or higher. I don't know if I subscribe to that. I think that there will be downward pressure as inflation does get more under control. And then I also think, from a political standpoint, when we get closer to the election, I think those in power are going to do everything they can to try to get the housing market moving on some level to look good economically coming into an election cycle. I don't think we should put it past.
We're hopeful.
The a presidential, incumbent to try to put pressure on the Fed to help that from a QE standpoint. But who knows? I don't know.
How do you feel about that?
About what?
Well, I mean, I get torn, right? My biggest concern right now is that we don't just take our medicine and go through it. So there's
a little bit of fluff on the top right now, though, that we all kind of have to know this.
So is your question, how do we feel about the Fed interacting, doing what they can to manipulate?
Yeah.
Okay.
In general.
So here's my answer to that.
It's,
they shouldn't be having to do that in the first place because all of the monetary policy that should be in place that creates responsible spending on the part of our federal government and all the and I don't want entitlements aside, all of the discretionary spending.
Yeah.
If they weren't creating such a debt mess for us, then the Fed wouldn't. It should never have been the Fed's responsibility to have to manipulate to create economic stability and economic opportunity for everybody. They're stewards for sure of the financial system, but Congress should be doing their job better.
Well, we can all agree on that. That is for sure. Well, it's scary.
I don't know if that answers your question.
I mean, yes and no. I mean, okay. I look at it like, I think the biggest threat right now is that the unemployment rates start to drop, and Powell just says, all right, we're going to reduce rates, and if we're, what are rates right now? 7.5%, something like that. 8, So imagine. You mean unemployment? No, I mean federal funds rate. Federal funds rate is, I think it's 7 or
7 3/4 maybe.
Mm-hmm. So let's say, remember 2 years ago it was 0. Right? 0 to 0.25%. Yep. And so what if he said, all right, things are good, or the economy needs to be, have the flames stoked a little bit. We're going to drop rates to 4% again, which would be great for mortgage rates, great for, car loans, great for, everything except for saving, right? Except for savings rates and bond rates and all that stuff. So it would be great, but it would also
it's not going to help affordability,
and it wouldn't help the future. We've come through this position or this time where it's all artificially inflated based on bad monetary policy. And so
I think if they could just start buying our mortgage-backed securities again and make that a part of the plan, then it could bring that, the comfort zone would return again back to the market. And we wouldn't have I mentioned the fluff. Yeah. We wouldn't have the fluff sitting where it's at right now. Normally we're sitting between the spread between the margin on the yield on the 10-year treasury, pushing 5%, breaking 5% for the first time ever in history. And then you've got the mortgage rates that, generally they typically will float between 1.75 and maybe 2.25, 2.5 on top of that 10-year yield. Yep. And right now we're sitting at 3% over the yield on the 10-year. And so I think if the federal government said, okay, we're going to go back in, we're going to start buying these bonds again, mortgage-backed securities, which trade a lot like bonds. And if they start buying these bonds again, which they've reversed course on that whole.
They didn't just slow.
They stopped.
They shut the whole thing. They just shut it down.
And they didn't just shut it down. They were undoing their balance sheet of it.
So which does what? It causes concern in the market, and now we've got to entice the investors to invest in these bonds again. But if we don't feel comfortable about buying them, how is anybody else supposed to feel good about investing in these bonds?
Yeah. The question is, why are they not comfortable? Right. Like that's the big, that leads to more uncertainty.
They had too many of them, which was, that's,
they didn't collect too much of it.
So as they're buying all this, they're buying it all. And then all of a sudden they're like, okay, we need to stop doing this.
So, and investors are largely going the other way. They're fleeing from bonds right now. And so what do you have to do to sell bonds is you have to raise the premium. The rate premium is huge right now, which flows through to mortgages.
Well, so if the mortgages are on the other end of that curve right now because they have to have the margin for error built in, and that's where we're at right now. So so really, I think along the lines of what Brian just said about your question, what do we tell our customers? Where do we see it going from here? It's like, well, if the federal government were to reverse course from their reversed course, and start buying back these mortgage-backed securities again, then we'll see mortgage rates that yield come, the margin between the fluff. The fluff margin will come back down in line where we're supposed to be. And maybe we'll start to see mortgage rates coming down a little bit within that 2% of the yield on the 10-year.
But I think, and that this,
which leaves us around like,
this is all really, really important. But if we're talking to our borrowers, they're not. This is about,
that's the macro stuff. They don't really care as much about that.
This is, can I afford the house right now? Do I want to buy right now because the value is going to fall and it's going to put me in a bad predicament?
Brian, do you think I should buy right now?
Well, Jay, let me ask you something. Have you done the math? Can you, regardless of where rates are today, do you need to move for your family? Would it be good for your family to make a move right now?
Well, I want to upgrade from a 3-bedroom to a 4-bedroom, and we have another baby coming.
If it's a good time for you to move and your family would benefit from moving, and you've done the math and you can afford the payment, you feel good about your employment security. Now, that's a big question for a lot of people. Then yes, it is a good time to buy, I think, because you're not competing with 20 other people and 5 cash offers, and you're not having to give up the appraisal or inspection contingency. You can negotiate the deal and get buy downs. I mean, there's if you're in if you can say yes to those questions, then it might be a good time. I mean, but for a lot of people, to be fair, they're not in that position, so it may not be a good time for them. Like just because I want to doesn't make it necessarily good decision.
Or like you just said, like, hey, I'm concerned one of us may lose our job next year.
Which is legit. I mean, unless you're like a nurse or a teacher or something, like that, I don't think a lot of jobs, I think most jobs are not safe at this point in time.
And 2-income families are certainly on the rise, and dual income, and you're having to use both incomes to qualify.
Definitely.
So when one of those incomes goes away, it makes a real big impact on your family's ability to maintain that house.
Wow.
Yeah.
Well,
insert the generational.
It's not all rosy.
But I do think for those who are actually buying a home right now, I think we don't have a crystal ball and we can't promise this. We can never guarantee it. But I think there's a really, really high likelihood that rates do come down to a point in the next year or 2 or 3 years where you'll be able to refinance and bring that rate down and be more comfortable in that house. But it all starts with you being able to afford it and really benefiting potentially from that purchase right now as a primary home.
Okay.
Different story if it's an investment property or second. I mean, the quick answer is it depends. Should I buy a home right now? Well,
I think it's going to get better the further we get from in time.
Okay.
The further that we get in time from when the rates used to be 2s and 3s, because again, you've got a whole generation of buyers that have never experienced rates, period, let alone rates in the 2s and 3s. But if all their friends and their uncle and their parents all have rates in the 2s and 3s, well, this is something now I have to consider. But if you've got this whole generation of buyers that have not ever seen an interest rate on a mortgage before, what difference does it make?
Yeah, that's a good point. That's a good point. I think there's a lot of people right now that are doing things that are moving their mortgages into trusts and stuff like that. That way, from a generational perspective, that is an asset, right? That could be passed on, and like it's legit. Like it's becoming a bigger part of estate planning is to lock in, for 30-year periods or however long they have left on the term. It's something to take into consideration. So in 2008, 9, 10, 11, I guess probably not so far as 11, but there was a big shift in, people like left the mortgage business, they left the real estate business, they got into other things, and, they couldn't weather the storm, and one of the things that I kind of have been talking to, because, we deal a lot with mortgage people across the country in real estate. My wife is a real estate, agent, your wife's a real estate agent. And, it's one of those things where I read a statistic the other day, for every real estate agent, there's only 1.8 homes sold right now. And that's not the average real estate agent only sells 1.8. That's like, if there's 1 million realtors in the country, only 1.8 million houses are getting sold. Like, so that just goes to show, if you understand the nature of the business, which I know you guys do, there's big teams and big people that are gobbling up most of those sales. So that means most agents are not selling anything. Correct. At this point in time, which that, and so that I would, and maybe I'm wrong. I'm making statements, but I'm actually kind of making statements in the form of a question, is that like, that would lead me to think that most mortgage officers are the same, brokers are the same deal. It's like, it's like the people that are really in this, that have their businesses like you guys, are going to be gobbling up the business. And there's going to be a lot of mortgage people. Like, as tough as things are for you, it's worse for others.
Correct.
Right?
Yeah, it's like a famine in our industry right now.
So something on the order of 50% of licensed loan officers did not renew for 2023.
What?
January
50%
of 2023.
Yep.
Already,
and we'll probably see a lot, bigger, that number adding up, come January 2024, which is great for those of us who are grinding it 100%. Out and positioning ourselves to be able to take advantage of that when it comes back around.
So this is, I wasn't going to go here with this, but it just it came into my mind. It's interesting.
It's your show, Chris.
Because I talk about the importance of saving, right? And the importance of financial structure over rate of return. And the fact that you guys are naturally savers, the fact that you have your business and that you're able to kind of like manage your cash flow and do all the different things. Not that it's not easy, right? Like, I'm not saying it's not hard, because it is, and you got to make challenging decisions, to manage it. And that's life, and that's business.
Saving in and of itself is a bit challenging.
Sure. Well, right now, but you guys during the good times were able to, and that built your coffers. So you had it. So even though you had to make challenging choices, now what's happening is, as you get through this, you're able to weather this. Like, if you didn't have that war chest, you wouldn't be able to do this. You'd probably be boarding up and being like, one of the 50% that isn't renewing or doing whatever, right?
Doing something else.
And so the power of the leverage that comes with having that savings, and the potential rate of return on the back end, it's not like, am I earning what percent per year? It's like the capacity that's created by having that there to put you in a position, because I truly believe any real estate agent that survives, any mortgage broker that survives, you're going to kill it on the backside of this. Like, it is going to be amazing, right? Because it always is. Anybody that can survive, it's like you have such a leg up on anybody trying to regain the force. Because 50% of people, it was probably bubbled up a little bit as far as people in the business, right? Yep. But let's just say out of those 50%, like 30 of the 50%, which, or 40 of the 50% were actually supposed to be here. Like, say there's like 20% like bubble.
Yeah, and I haven't seen, I haven't dissected those numbers, but I'd like to think that the majority of that 50% were probably really recent loan officers who came in right before or during the pandemic where refis were going nuts.
And they just joined at the wrong time. Basically. Or like, in their eyes.
We saw a lot come into in 2021, because they're like, oh, my friend's in the mortgage business and he's doing,
he's killing it.
Doing really well, did awesome in 2020 and,
Yeah, totally.
And they kind of rode in on that, the coattails of success,
So like, what do you do? Like, the people that are what are they doing to get through, like, cause one of the things we're doing, and we talked about this a little bit, is like, I'm a firm believer, like, have life insurance is a huge part of what we do, and teaching financial security is one thing, but like for me, like if the hard time for me is when things are going really great, right? And like, it's hard to get people to be like, yeah, take your 4.5%, 5% and be safe and be like, then people's like, dude, have you looked around? Like, it makes no sense. Why would I only do 4% when I can get 15 over here? Like, that's the famine for me. And you guys are like the opposite, right? And so like, I know what I do in that time, but like, what do you guys do? Like, what if you were talking to all the mortgage officers like watching this, or brokers watching this, like, and they're sitting there on the fence and they're like, I don't know what I'm going to do. How can I make this work? Like, what would you like? I mean, any words of hope? I mean, cause like you guys like do a really good job. Like, and you've built a great brand. Yeah. You're like super connected in the community. You know, you got a great team. You know, you're weathering the storm like anybody, but like
that's a loaded question, Chris. I mean, it's because honestly, it starts before. What do you do? I mean, it starts before you hit a patch like this. Calling it a patch because I think we're going to come out of it.
Sure.
We started planning for this in Q1 of this year.
Well, I'm going back
like this moment.
I'm going back to when
was being planned for in Q1.
I'm going back to when
even before
we had we had all kinds of business with refis and everything else coming on, and had a huge excess of income coming in because of that. I'm still driving my 8-year-old truck that's paid for.
Love it.
I didn't go out and buy a new vehicle.
Ferrari. He did not buy the Ferrari.
A lot of how we were able to fund My City Lender was because we had saved and we weren't overspending during that period of time.
That's
I mean,
huge.
it's kind of like
that is a big deal.
But we haven't taken on any debt.
Right.
So Brian and I, neither one of us have taken on any debt to fund anything for My City Lender. Like it's all been, everything from cash, and everything from, everything that we've saved up. So it's, if we could give anyone any kind of hope or, plan for the future, what to do right now, I would say if you can afford to hang in there, hang in there and keep doing the work. Don't take on any debt or any expenses that you don't need. In fact, reverse course, like you just mentioned, cut everything you don't need, cut the subscriptions that are haunting your credit card statement every month, and get a side thing going.
I was going to say, is it normal to get a side hustle
going right now?
Work a business?
I have a real estate development side hustle.
Like
that's a fun side hustle.
Like when
I'm in. Let's
eggs
go.
are in the same basket-ish, but
I mean, it's like if it gets to be like this, you got to do something, you know. But throwing in the towel is not that isn't going to get you to the other side of what's going on right now.
And just, on the personal side, you got to shore everything up, and you have to be very intentional and responsible with your money. But on a business development front, so what do we do to do enough business right now to get to that point where we're going to be thriving and killing it again? I think you have to be laying foundations, using the time that you have, because we all have a little bit of extra time, and laying foundations. Like we're really going after building the Jane Bryan Show. We're with the Jane Bryan Show. We're able to talk to, all manner of different professionals in and around the real estate industry, but also more broadly, like life insurance and meeting really awesome people and networking with that. And I know that's going to turn into future business opportunities for us as well. You have to find things now more than ever. You have to find things that others aren't doing and do that and do it well. And you'll find enough business in the meantime. And then you'll have this great foundation to really springboard off of when the market turns into
networking.
Favor.
I mean, that for what we do, networking is everything. And so if you give into the fear, you're going to give up on networking. So if you've got to get to the other side of fear so that you can continue to, put your feet forward every day to be meeting new people every day. If you're going to stay in this industry, this is the fuel of our industry is relationships.
For sure.
And networking is, that's how you're going to get to the relationships. So if you give into the fear, the relationships are not going to happen.
Right.
Yeah.
That's it. You're going to shut down and, that'll be the end of it.
So it's an opportunity because you guys have more free time now because you're meeting less clients coming through the door.
Yeah, so we're replacing that with, we're doing expos. We're doing other networking events as a team.
Yep.
We're getting out. We're in the public. We're in the community.
I'm teaching real estate agents about how to establish a YouTube channel.
Are you?
He's teaching YouTube
Amazing.
classes.
And I tell people, every time I get a chance to be in front of that class, I talk about those who we've met who have been really big influencers in the direction we've taken the Jane Bryan Show. Chris Kirkpatrick being
well, if you want me to come
one
on
of
and
those
help, I'll
important
come
people.
on and help.
That would be
That would
awesome.
be
I'd love to
amazing.
I'll come on and do that with you. That'll be fun.
Yeah,
I love it. Yeah, I mean, like we're in the process right now, and we talked about this a little over the weekend, but like we're in the process of, and this isn't a sales pitch, but like to any mortgage person watching, like I firmly believe like life insurance is a great side hustle for anybody who wants to get licensed, for real estate agents, for mortgage officers, for anybody, quite frankly, that's in a space where you are coming up tight against it. Now, it's not for everybody, because sometimes people just need a salary, and you're going from one commission thing to another commission thing, and there's certainly a learning curve and a process that you
so 30,000 feet. Give us the 30,000 foot view of the process of becoming a licensed life insurance.
It's the easiest, simplest, stupidest process ever. No, it's easy. It's like literally it's 20 hours of studying and pass test.
Okay,
like that's it. It's so simple. It
does sound easy.
It's if you can pass a mortgage test, like, which is infinitely harder, you can pass the life insurance test. It's just and to that point, a lot of real estate professionals and mortgage professionals have time to do the 20 hours. You can probably bang it out. Like when I first got my life insurance license in 2009, it was May 5th, 2009, and I went through and I was told about it. And by May 15th, I had studied and passed the test and like gotten all the paperwork done and through, and I was approved with the state. Like, I think I studied for 4 or 5 days, and then it took like 3 or 4 days to set the test up, and then I took it and it was all done. Like, that's how fast it can go. But you got to take the time to do the stuff and
commit to it and do it.
Yeah. And it's,
but it sounds like a realistic side hustle.
It is.
Like to add to your, financial services.
Well, to me, it's like the natural market, like it's the same, right? Because everybody that I just believe, like for the most part, most of the people that are buying homes are married, have families, not always, but a lot. You probably deal with a lot of family people, families. For sure. And so like, those are the people that need life insurance. Those are the people that need on a bare minimum to like make sure that their debts are covered if something tragic happens. But then we start talking about all the other things that we've been talking about emergency funds and opportunity funds and just saving and all that stuff, and like that's a conversation that I think a lot of people are interested in. And so the biggest thing is like it's you don't have to give up your mortgage license to do it, right? So if you could add in a line of business that doesn't detract from what you're doing, but adds value to your current client base.
Yeah, why wouldn't you?
Why wouldn't you do it? You know what I mean? And so once again, it's not for everybody, because you got to get licensed, or you got to do, different things. Or maybe you just like, there are times you guys do meetings, like you're teaching real estate agents, right? Like, and so is that just a value add thing that you do just to build relationships? Right? Exactly. So it's that kind of thing. So it's a same kind of deal. Maybe you don't get paid on it, but it's a value add, and you're just keeping those relationships. And through that, you get 4, 5, or 6 extra referrals, and you make your money that way, right? Like it's just a value add, right? And so I'll just do this because it's going on our channel. So like if anybody is a mortgage broker around the country, that's what we're putting together right now, a whole program for mortgage officers. That's going to be like a webinar series for people that don't want to get their license, that don't want to like put a lot of energy into it, but you want another like value add, which right now it's hard.
So I mean, that is part of the problem. And this is one of the things that we talked about a little bit this weekend was that there's this massive reluctance right now to call our customer base. Yeah. Because what are we talking about? What are we talking about? Right. Other than woe is us, How are you? Woe is us.
Yeah.
But totally. Like to have a reason to actually pick up the phone and call everybody again to talk about something. Yeah. I think that's a great idea.
Well, and you guys have great relationships, and I would assume that most mortgage brokers like have great relationships with their clients, right?
And they're
like
trusted. We have a lot of, hey, I've been thinking about doing this, or this is what, my families going through right now? What do you think? Do you know somebody that does this, that you could point us to?
Well, outside of an accountant, CPA, financial, like you guys see them financially as naked as it gets, right? Like, so you
Definitely.
know everything about like, so people trust you because like it's a very revealing process going through and getting a mortgage, right? And so like that trust, like you have to trust the person you're working with or you're getting a mortgage. And like, so that says a lot. And so, and it comes with a lot of responsibility. So like, like I think especially now, I would encourage, it's the old idea of like crucial conversations, right? Like just because you don't have something good to talk about doesn't mean you shouldn't be talking. Like you got to be able to have those hard conversations. But what if through the hard conversation, you could instill value? You know what I mean? It's like, hey, it's not easy right now, but here's what's going on. And like, as we all weather this storm, like what are you considering this and this and this and this, And I know we're your mortgage person, but like at the same time, like as you're weathering this storm, have you considered all these things? Like, and that's a great way to work out. So what we're doing is we're putting a webinar together that helps kind of communicate all that. That way, like,
awesome.
As people like you or any other person in the industry says, hey, we want to just like, it'd be cool, like as a value add webinar.
I just want to listen in.
Yeah. I mean, right? Right?
I'm intrigued now.
Yeah. And that's the thing. And so it's a great value add. And so, we're working on doing this thing. So anybody who is a mortgage officer that wants to get licensed or whatever, feel free. I'll put a link in the description below. You can go down and check it out and, get licensed easy. We can get you contracted, do, all the stuff. You do got to get E&O insurance and there's like anti-money laundering stuff that you got to pass and all the classic, stuff.
We know all about that.
Yeah, exactly. And that's the thing. It's like, it's not rocket science. Like if you're in this industry, you understand there are things you got to do, right? Like it's just part of the process and the E&O insurance. And I'm sure you guys got all the same stuff, right? And so it's a little bit of a different thing, but it just seems to me like it makes sense because of like you got a couple hundred clients and like you could serve them and you could add value. And if you get licensed, create a side stream of income as well by serving the same people and not having to disappear from the industry and not have to like all that stuff. If you're in it anyway, it just makes sense. So cool.
Awesome.
Cool. Rock and roll.
Yeah, cool.
Well, guys, thanks for coming on. This is fun.
Thanks for having us.
Definitely. Thanks for having us.
We'll have to do it more before I bounce the country.
Well, we're working out how we're going to do this remotely anyway.
Well, you guys are going to come down to the DR.
Dialed in, and we'll be in the studio in the DR.
Perfect.
That'd be awesome.
Yeah, you got to get down. It'll be awesome. All right, guys. Well, all the links are going to be down in the description below. So I'll put the link to the Jay and Brian show. I just did an interview on their channel as well. So I'll put the link to that down below. Go follow these guys. They're amazing. They interview some amazing people, have great conversations, great insights. Go check them out. That's it. Until next time, have a blessed and inspirational day. We'll talk soon. See ya.